come down, pack rats come down and start looking around. So I had a rat trap set, and I caught a skunk. And so,
Oh man.
oh yeah, so it's the fun never sets here in California. You guys don't know what you're missing.
Oh man, that is just sad. So, how are they doing on the fire?
This one that was north of us, that was the big worry. They've got it, 65% contained, and the wind is come up from the south now. It was coming from the north, and they were afraid it was going to blow it right down into Santa Rosa.
Yeah.
But now it's coming from the south and kind of blowing it off into a place where there's not many houses and not many people, and it'll these things, they don't really ever put them out. They just sort of burn out, or they get a little rain on them, and that sort of stops them, or they blow back on the areas where they've already burned. So I think that's what's going to happen with this one. And they said they had 160 or 170 homes lost, but no lives lost. But they were really cautious. They evacuated areas that they probably didn't need to, but they just didn't want to have a repeat of 2 years ago where they lost so many people. But right now it's looking good. Southern California is actually in worse shape than we are now.
I didn't know that.
Yeah, because they've got the winds down there haven't given up. Our winds have stopped, but they've got that ongoing. They call it the Santa Ana wind, and so they got 3 or 4 active fires within kind of metro Los Angeles. So it's a tough one.
I don't understand this. These winds you're talking about have been there since California's been there.
That's true.
What's changed?
Well, 2 things have changed. The biggest thing that's changed is people are now living in areas where they never lived before. So, people want to go out into the, make their home out in the wilderness kind of a thing. And so suddenly now they're expecting the fire department to protect their homes. And the other thing is, because of this extended drought, things are much drier than they would be normally, so that when you do have sparks, they really get going. And we've had a fire suppression policy on federal lands. I'm sure it's the same in Utah, where they put out every fire that starts instead of letting it burn a little bit. So the tinder and the flammable materials have built up and built up. So it's it's a real problem. And I don't know, the electric company, everybody's blaming the electric company, but the fact is that only 10% of the fires that start are because of electricity. The rest of them are lightning strikes or people's stupidity. So it's going to be, I think you're going to have it's going to be an interesting 4 or 5 year period here while they figure out what to do. But I think it's very likely that we could have a state-owned utility here before long.
Oh yeah, I think so.
Yeah.
Which is really humorous considering you're a bankrupt state.
With a bankrupt utility, so I don't know what to do except move to Utah.
Yeah, there you go. It's actually kind of fascinating to watch. The humorous part for me was that they come through and shut off all the utilities to the houses, and then they leave the most dangerous part, the high voltage lines. What do they do there? Why don't they shut those off?
Yeah, right.
I guess I don't know. That's kind of silly. But the other thing that, to your point about controlled burns, that's exactly what caused our fire here, was a controlled burn. The lightning started a fire on the backside of a mountain. They just watched it, figured no big deal. They're going to let it do a controlled burn. Then the wind shifted.
Uh-huh.
And I was talking to the guys in charge of it, and they're looking at it saying, if we don't lose any homes and the forest burns, this is a good thing. It needs to happen. But they received such political condemnation from all the residents and people around. What are you doing? Why didn't you put a fire out? People just don't understand that it's a necessity.
Right. And that, until we get of the political will to to have burning areas that don't impact houses or people. Whenever people come out here to visit, and we take them out to the redwood forest, and everybody's nervous about earthquakes, but I always start out and say, the history of California is not earthquake. The history of California is fire.
No kidding.
And that has shaped the state from day one. Hi, Julie.
Chuck says hi.
Hey, when are you gonna get out of California?
I just told Randy we may have to look to move into Utah anytime soon here.
Okay. He says he's going to move to Utah,
Okay,
and he says get his bed ready.
it's ready.
She says it's ready.
Thanks, Julie.
All right. For everybody's information, I am recording this, so don't say anything you don't want in the recording, and then I'm going to post them. And I'm going to do that for the benefit of those who can't meet this schedule. And I'm hoping, if I can figure it out, that the recording will be posted to right in this Teams area. As I mentioned in the chat, I am changing directions with this class. How did everybody do at the document I sent? Was that just confusing?
I didn't get very far on it. With Halloween yesterday, I managed to print it out and start this morning. I think it'll be helpful though to go through these worksheets. I just, I only just got started.
Okay, anyone else? Slackers.
No, I thought, Randy, it's a good beginning to really, just even the, identifying conditions. I think that's so important in your trading is, particularly if you're looking at buying things and holding them and wanting to own them, it's always good to look at what the conditions of the market are, because that can change your opinion about owning something real fast.
Yeah. So review that, and there'll be elements in there that are difficult to understand, or you may not, like the relationship of historical volatility to implied volatility, but we're going to cover it. One of the reasons I'm changing is if we should be trading to beat the market. And if we're just matching the market or we're underperforming the market, then forget this. Let's just go buy a bunch of SPX or SPY or something like that and sit and let the market go up and down and check our profits at the end. So right up to this point, really what we've been doing is just looking at pattern recognition. Hang on. So, we come in and we look here, we say, okay, well, the stock's down in Tiffany a little bit. I'm going to sell a cash secured put and collect that revenue, and that's okay. But there's a lot more to it. And so I'm going to switch to where we're focusing more on the Greeks. And specifically, we're going to be focusing a lot more on volatility, to where volatility is driving our decision making. Having said that, let me pause just for a second. Does anyone have a trade they're concerned about before I jump past that? Because that's our first priority. If any questions on a trade or anything, we'll hit trade ideas a little bit at the end, but this is just like right at this second.
Nope, not from here.
I don't know who it was that had Tiffany, but I hope you still have it.
There's a reason that I picked Tiffany, because I'll move forward with it right now. At this point in time, I own 200 shares of Tiffany I was assigned them a while back. In fact, I think I was assigned them here at 91. But I had been writing calls against it, so I would say that my basis is probably 89 on this date. 89, I own the stock, and I'm going to go ahead and write. I actually 200 shares. I wrote 2 calls, and I purchased or sold 1 put. So what that looked like. Here. There we go. Is I ended up with another 184 deltas. So I'm starting off with 200 deltas, which means I want the market to go up. And whenever you're dealing with stock, your risk is 100%. So I have 200 shares, 200 deltas. So for every dollar the stock goes up, $200. And then there is no other Greeks because this is not an option. So I'm leaning way positive. I want Tiffany's to go up. If I sell the put against it, that is still sending it up, and that adds another 96 deltas. But I also sold 2 calls for 193. So watch this 200 deltas. Clear down to 15. I'm at 0. And the reason why, that's why. So this is 180 deltas, 190 deltas. That zeroes that out. That adds in about another 90 deltas. So adding them together, now I'm only up 290 deltas. So I'm still leaning way long. And I want to go up. But what this means is that I only can gain profit from my 91 to 93. Once it hits 93, that's 2 points. I'm out of the game. If it runs down to my 86, I own another 100 shares. Well, the question is why do that? And it's the mentality of I'm going to get as much as I can because it's a great return on my investment. But the switch I want to make here is that instead of you should be making a good return every day of the week, but set yourself up for an outstanding return if the market does something. By that, I mean, if Tiffany's all of a sudden crashes, if all of a sudden China says, we're never going to buy any more Tiffany's, and it goes way down, you don't want to be sitting and losing $300 a point every time it goes down. You want to have some sort of risk control on the bottom. So I'm going to go back here to the 8, and these numbers. Well, let's back up. What day is this? Sorry, this is the 21st. So what I'm going to do? Am I blind or what? Hang on, I'm struggling here for a minute.
You got to compress your chart a little bit, Randy. To get back over, no, drag across where the prices are at the bottom of your chart and compress the chart so you can get back to 90. No, not up there. Yeah.
What I'm looking for here.
Right.
I got it. I'm okay. Trust me.
Okay.
What I want here is to go to on demand. What date did I say that was? The 21st?
Uh-huh.
Oh, I'm already there. Cool. Is it? So these are the prices on the 21st. Well, I want to spend some of this money. I mean, this is a huge return on your 91, your risk. If I had if I'm buying a 91 shares or $91 share, that's about $9,000. But I can get um, the stock or I have leverage, so really it's only going to cost me $4,500 to hold this thing, because the brokerage is covering half of me. But I had two shares or 200 shares, so I'm back to the 9,000. I just want to make sure you saw how I got there. If I execute this and it's a 2-week trade, that's $258 times 2, right? No, that's for the whole thing.
That's for the whole thing.
$258. So if I take $258 and times it by 2, that's $516 a month. And if I multiply that by 12, if I did that all day long, I'm making $6,000. Divide that back out again by my 9,000. That's 70% return on my money. I don't want to make that much because this is every day of the life. I only want to make 20%, so I can afford to spend some of that money. So let's spend about 40 cents or so. We're going to buy, and these prices are not accurate. What if I go to the last? Will it even show me the prices back then? No, see, it wasn't traded. So let's say that I bought that for 50 cents. And I'm going to buy 2 of them. And let's go up here and spend another 50 cents. And buy 2 of those. All right, so now instead of making $2.58, I'm making how much?
$1.50.
$1.50. So and I'm going to just use big round numbers for everybody, all right? That means instead of making a 70% return on this little trade here, I'm making, what, 30%, 35%? Now, if we could do that every day of the week, 35%, we'd be really happy, wouldn't we? But the thing that this did is I still have risk from this guy right here, but I cut my deltas down to only $100. So if this thing drops down, I'll end up owning it at 86, and these will be closed out. Back to my chart, I'm going to be owning it, down here at the bottom, but I'm only going to own 100 shares. Pretty good risk management, I would say. But what does this mean as far as dollars and cents are concerned? Let's take and get rid of this call. No, let's get rid of both of these. Here's my position. And let's go to today's prices.
Got to reset your date up on demand.
There you go. Thank you. How do we get out of demand? Just click on it?
I think clicking it goes off. There you go.
There we go. All right. So look at that. I made $655 today on this original trade. Is that good? Well, what if I hadn't sold this call?
We have quite a bit.
I would have made $7,000.
That's the best that we have got it to so far.
That's kind of unfortunate, huh? Which one do I want? And the reason why is because Tiffany's had an offer to purchase. And if we move forward in time, boom, 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 boom. Look where Tiffany's went. This is what I lost out on. Now we go back here and look at this. And before I do that, well, I'm not going to. You know that this put is a protection on the downside. And my risk on these two is just the difference between this 83 and 91, 6 or 7 points. So coming down here on these 200, I would have lost $700 or something like that. But I would have picked up another 100 shares. But what happens if I would have purchased these two calls right here? Now look at my profit. I almost got all of my $7,000 just by sacrificing a little bit here. Did everybody follow that?
Yes.
All I end up with is a little bit of a call kicker. It's called, I don't think it's going to show very well. Let me just get rid of this and it'll show. No, it didn't show better. It's a risk reversal. So that, I make all of my money from selling this coming up into here. But once it hits that 94.5 right there, then I'm participating again. Most all the time you do this, you lose this money. It just goes the way of the world. And it's kind of tough to take to think that I lost it, but I'm making my money right here, and I'm using this money to finance these two kickers. In the document down here, when I say, I should have said, describe your financing mechanism. That's what this is. This is financing these guys. So trading from this point forward is, from what I'm going to show you, is two things. One is we're going to talk about trades in terms of the Greeks here, not in terms of the pictures. Two, we're going to be trading to make a reasonable return on our money we have out, but looking for opportunities to set ourselves up if something happens either direction. Now, this particular put here is only a safety net to keep me from losing money, but there's ways of taking some of this money, like purchasing a put butterfly or something like that, where you can actually set yourself up to make money or break even. I mean, imagine if you had a catastrophic collapse of Tiffany's, and instead of losing $6,000 or $7,000, you lose $500. That, to me, is a winner. So we're going to look at trades in this terms. And if I'm going to do this, we really want to focus a little bit on the Greeks and understand what they are. And especially understand that implied volatility is the key to everything. So I'm going to spend 15 or 20 minutes here just showing some relationships. And then starting our classes going forward, I'd like them set up as, this is the trade that I proposed in my document. Here's where I've executed it either in paper or in real life, and here's how it's performing. And we'll be doing all that based upon your analysis of the Greeks. In order for us to beat the market, we have to look for something that's out of ordinary and then capitalize it. We want to look for some sort of edge. I'm going to play the chart now. And if anybody has questions, ask me. a lot of times we'll have these moving averages in here, 10-day, 20-day, or 50-day. I think that one's 50, isn't it? Doesn't matter. Yes, 50, 200. And that gives us a really good idea of, the price movement. But I kind of want to know what the price movement is doing over a period of time. And so that's why in the document, I talk about 10-day, 30-day, 90-day, and a year. If you look at the historical volatility, let me back up. I want to define historic volatility. And I'm going to do that with not that for sure. I don't want to even look at that one. Plural side. These averages and historical volatility is just realized volatility. All you're doing is you're averaging out this price movement, getting averages like these averages across here. The most common way to do it is close to close. So what they'll do is they'll say, okay, this puppy closed at 3009, this one closed at 3007. I averaged these two together. My average for 2 days on this is 3008, right? So you just take each one of these closes, add them together, divide it by 10, or let's say I'll take these 10, add them together, divide it by 10, and I've got my 10-day historic volatility for this particular product. Well, that works. That's common and it's okay, but there's also a nuance to that, and that is when you look at high-low volatility. What did I say I was going to use? Oh, I'm going to use Johnson & Johnson. If I just take these 3 days and I look at it, this candle right here, and you want to know how I'm telling quickly, I'm just looking up here where you have high, low, open, high, low, close. So I put my cursor over it, I look up there, and the close on that is 133. I move to the next one. The close on that is 132. So there's only a 1 point. The average of those 2 days is only 1 point. But if I look at high-low here on this one, it had a high of 33.5 and a low of 31.5. I'm rounding. 2 points. So this candle alone moved 2 points. Now if I look at this one, high-low, it had a 33 down to 31. Again, 2 points. So what is the actual average of these two? It's 2 points, not 1 point. So when you get an instrument where it's moving a ton and it has a whole bunch of candles like this, you're accurate. You want to be a little more accurate. You want to look at high-low volatility rather than just close to close, because if you set up a trade, and you'll cover this in that document, it isn't just good enough that you end up where you want to be. You have to be able to endure this movement inside of here. So if you wanted to end up here, can you endure traveling clear down here and then sit it out until it comes back up here? So you want to look at that high-low volatility. But if you come back to something like, I was going to go to GE, but GE's actually, I think, gone crazy. Yeah, it had. Craig, you should be happy about this one right here. But sometimes you'll have stocks, they'll just completely go sideways, very little volatility. Well, even this one, just taking open or close to close on this one, you don't have a lot of these big tails. This is going to be accurate enough. So what I want to do is I want to look at close to close, year 90, 30, and 10. So I'm going to bring that up. I actually had created these studies, and I don't know if you guys have them or not, but I'll share them with you. So I have my historical close and my historical high-low. Let me just activate them. And we're only going to talk about close to close right now, this guy. So here, a year, 90 days, 30 days. Is that right? Yeah. I don't even have a 10-day in here. And then this one is implied volatility. And I believe TOS, I'm struggling to look at it this way. I actually do this on a different platform, but I wanted to do it in a way you guys could look at it. Implied volatility is usually looking at 30 days. So that's why I like to have this 30-day in here to compare historical volatility to implied volatility. Now, what causes volatility? And I got to make sure I say this correctly, but it's back to price action, and who is buying and who is selling, but who is actually adjusting this volatility? It is the liquidity providers, the market makers, the person on the other side of your trade. They are going to adjust volatility because it has a direct relationship to option pricing. I will give an example of that. This is the TD Ameritrade butterfly that I had you guys put on. Now, if I click on just this, you're going to notice, and it's tough because this is, yeah. Sorry, I'm going backwards. I didn't want to do that. Let me go over here, and we'll step out 13 days. We'll execute. Come on. Where's at the money? We're going to execute an at the money butterfly. We're going to buy a butterfly. Oh, look, I had an. We'll do it with my iron condor that I already had here. That works well for me. If you look at this iron condor here, it is sitting almost delta neutral. So the market right now is a little bit above the middle of this iron condor, and I can tell that because it's negative $80. It wants the market to move down $80. Did I say that right?
Yeah.
Yeah.
If you want, in your position, you want the market to move down to give you more profit.
Right. So if you look at this, you can see how looking at the Greeks is the same as looking at this picture. And I'm not talking about this expiration picture. I'm talking about today. Because every time today, and I'm going to stay here just for a second for transition. Every time volatility moves, this picture changes. But I can look here and I know exactly where I'm sitting. I want this thing to move down. Okay? You look at gamma It's minor, small compared to my delta, so we're not going to worry about it too much. Theta is time. This is rent. Are you being paid, or are you paying somebody to rent this position? $300 a day. I'm going to get into the ratio sometime between how much theta. You can have too much theta compared to the other Greeks, but right now we're going to ignore it. Look at which of these Greeks influences this trade the most.
Volatility.
Yeah.
Right there.
There you go.
1 point of volatility is $3,000. So if I take volatility here and I jack it up by, well, we'll only go 1%. Watch my profit that's up $1,900 right now. Did you see what it did?
Yeah.
So as I increase volatility, I'm losing tons of money. So how does that volatility get changed? Well, let's go over here. Well, I'll just stay where we're at SPX. Right now, the market is going up. Do you think people are buying calls or puts right now? If I ask you that type of question and you want to cheat,
Yes.
well, before I do that, looking at this right here, the market, it's gone up. Do you want to be long or short? Do you want to own it or sell it? I want to own it. The world wants to own this. It's going up. You buy when things are going up, you sell when they're going down. And sure enough, if I look here, well, it's almost even. Who cares? I thought I would see a little bit better, but it's actually, the move's already made. But still, more people are buying calls, not by much, pretty even. It's almost a 1-to-1 ratio. So we'll talk about going up, not what we would do this second. People are buying calls. They want to be long right now. So let's say I'm in that mode, and I'm going to buy 20 calls. Okay? That is 1,000 deltas. I'm long. Well, what did the liquidity provider have to do when I bought that? And let me make it clear what I said have to do. The only thing the biggest advantage you have over the people who are selling at the liquidity providers is you get to choose when you enter the market. I chose whether or not I wanted to buy those calls. They can't do that. If I bought these calls, they have to sell them to me, okay? They had no choice. So what ended up happening here is I forced the liquidity provider to sell 20 calls, and they're sitting there 1,000 deltas short. Now, do you think they want to be short? No, absolutely not. So what they do is they'll go out and buy 1,000 shares of stock. Okay? So I'll go out here and I'll buy, you know what? What am I doing in here? Duh. You can't buy SPX. Back in the SPY. Go out in time a little bit. We're going to go out 40 days. I want to buy 50 of these guys. I want the numbers to be big. Okay, I bought 50 of these guys because I want to be long with SPY. just to be clear, I switched to the SPY because it's the ETF of SPX. It's 10% of the SPX. See, SPX is trading at 3,056. This is trading at $305. Exact same thing here. I bought this. What did I force the liquidity providers to do? They had to sell 50 of them, right? So right now, this is their position. They're short. So how are they going to protect themselves? They're going to go out and buy 2,000 shares of SPY. So now look at them, delta neutral. So this is the position that the liquidity provider is holding. They don't care so much whether or not the market is going up or down. They're just going to hold this and try to move it out for a profit. Now, what is the liquidity provider's biggest risk here? Looking at the Greeks.
Still their volatility.
Still volatility. So what do they want volatility to do?
Go down.
And that's exactly what they will do. They'll get on their little teeny computer and they'll drop volatility. This is, I'm working in extremes here. Wow. Look at, now what did I click on? A little extreme here. Well, let me before I get to that, I want to show you the picture. The picture of their position. What is this position that they built? And it's a straddle. The reason why I want to show you this picture is when you're short a straddle, which is what they are, whenever you are, most of the time, if you're a long theta and short vega, you do not want the market to move. You are short. Now, watch what happens when I increase vega, volatility. Market makers losing money. Do you see that?
Yeah.
They're not going to let that happen. And the reason I'm going over this is because I want to demonstrate the effect of volatility and what causes it to move. Look what happens if the market maker raises volatility 2 points. They raise volatility 2 points. Now they can turn around and dump their profit or their position and break even or make money on it. So the exact opposite is also true on puts. So how do you make money? Well, you make money by looking for these gaps in volatility where it's going to revert. I go back here to, I'm still going to go back. Well, I could probably do it on this one. Back to my chart here. And here's volatility. We've had a huge climb going up for here, which means people are buying calls. And at the same time, the liquidity providers are being forced short, so they are buying stock and lowering volatility. According to my example I'm showing you, right? Let's look down here. What's volatility doing? See how it's trending down?
Yeah.
I mean, we're ignoring the short spikes, but it's trending down. Volatility is going down because we're on a rise. Back here, people are selling or buying puts. So that means that these guys are buying calls and selling stock. So they want volatility to go up. And you know what? Volatility is going up. The thing you have to know that is critical here are two principles. One, volatility is mean reverting. It wants to go back to some sort of equilibrium. So if it's too high, it's going to force itself back down. If it's too low, it's going to force itself up. Rule one. Rule two is I just explained to you that the entire control over volatility was price action, people buying and selling stocks, which forces the market maker to raise and lower volatility. And this is ignoring any extraordinary events like earnings or my Tiffany's where there's an offer. This is just day to day. So if price action is controlling volatility, this implied volatility, which is the market's guess of where 30 days is going to be, wants to go to price action. So in the short term, it's going to want to head down to this 30-day. In the longer term, it's going to want to revert back all of these, the 30-day price action, the 90-day at price action, and the implied volatility wants to revert back to what's been going on for a year, for the past year. So if an entire year, I'm looking at the bubbles to the right, if over the entire year the S&P has had a realized volatility of about 15 or 16, do you think it can support, watch my cursor, a VIX of 12? No. This VIX has got to go up. So these guys are going to want to move back up here. So am I anticipating an increase in volatility? Yes, I am. Am I anticipating an increase in realized movement? Yes, I am. So back to my picture here of a straddle where I buy a call and buy a put, except I'm going to sell the straddle. So if I want to go into this straddle, I am anticipating and hoping that the market is not going to move. It's going to be real quiet and stay right here. Wait a minute. I just told you that I think that this 30-day price action is going to increase because its year average is up here. All of a sudden, the straddle doesn't seem like such a great idea, does it?
No.
Well, let's get a little bit more refined now. This green line is the 90-day. So it's still going to increase, but it's only going to be up into here. Well, an average. So maybe over the next 90 days, you know, it might, or 30 days, it might only reach up to here. Because, I mean, for the past 3 months, this is kind of what we're maintaining. So maybe if I set a 1 month or 2 month trade, I can anticipate it only move this far, not clear up to here. So maybe if I put together a trade that is wide enough to encompass this space, I'll be okay. Oh, well, let's go back over here. And instead of being so narrow here, let's spread this out a little bit. Oh, wow. Now I have a whole bunch of room for the market to move. And I'm anticipating it's not going to, maybe in a year I'm going to be in trouble, but in the next, however long I did this, 30 days or 45 days, it falls within that category of this 90 period down here. So I just molded that trade to fit what I think the market's going to do within this time frame. Now, the only other kicker here is, do I want to sell or do I want to buy? And that depends upon, and on that one is 100% implied volatility. If I stretch this out a little bit, the other way, there we go. And I take a look at where volatility is right now and kind of get a feel for, is it high or low? And I'm looking at the gray line. Do you think it's going to go up or down?
I would say up, but not by much.
Yeah, it's you want to pick out, cut out the high parts. And again, I only want to look at kind of a time frame, like from here to here. But if I'm going to pick an average, so right close to that 90-day mark, I think is going to be an average or a little bit above it. So I do think volatility is going to increase. Now, if I look at my little gray bubbles over there, I can see that it's currently at 13%. And I'm thinking, okay, it could rise to 14 or 14 and a half. So I want my trade to be able to survive a 1 to 1.5% increase in implied volatility. And so I come over here and I can increase my volatility by 1.5. And right now I'm pretty comfortable with that if that's the worst that's going to happen, especially if it happens over time, because there's a 1.5% increase. Let me put this back to 0. Number 3 rule: volatility equals time. Volatility equals theta. They're directly related. So I'm sitting here at $1,800 profit on this trade. If something happens or volatility creeps up 1.5%, I'm now down $2,000. But volatility equals time. This theta, tick, 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 tick. Oh, look, I just broke even. I increased this by 1 week, and I overcame a 1.5% increase in volatility. Next, and this is going to be the final thing I'm going to cover today because I've dumped a lot on you. One of the reasons I've recorded it. So volatility equals time. The last thing, the price is moving up or down inside of my trade. Even though this is telling me that I want volatility to drop, where is my greater volatility risk? Where can I endure more volatility? Up here or down here? That's a tough question. Volatility, if you are looking at the market, do you think you have a greater risk of the price going up or a greater risk when the price goes down? The answer is down. More people are afraid. I didn't even give you a chance to answer, did I? More people, I didn't want this to go for too long, so I'm jumping fast. People are more afraid of the market crashing than they are of the market going way up in the world. So consequently, volatility is going to this Vega number, and volatility is going to increase, get worse, slower going up this way than down this way, falling. So if I'm creeping up here, yeah, it's hurting me in Vega, but I can endure it a little bit better than if it's going down. On the the caveat to that, there's a lot easier ways to adjust down here because everybody else knows that. There are no ways up here. So I'll cover that more later. I didn't want to go there. Forget that. So the principle here that we want to focus on today is first, knowing these relationships, using what the market has done over a year, what it's done over the last 3 months. And the reason I picked 3 months is because most of your trades are not going to exceed 3 months. The reason I picked 30 days is because most of your trades are going to be within 30 days or slightly over. And implied volatility is looking at the volatility that's 30 days out. So what am I going to do? I'm going to look at historic volatility. Where do I think it's going to do? What's going to happen? Well, I think it's going to start getting a little bit more violent. You know what? And until it gets back up to 15. I think the market is quiet right now. Implied volatility. What do I think volatility is going to do? Because this is going to directly relate to the price I pay. Okay, and then we're going to use that to form trades. We're going to use that to going forward in our decision making as to whether or not we want to sell a put, sell a call, or hold on to our stock, which we're already doing. And then the final thing we're going to do is we're going to stop being greedy on, this ties together. We're going to stop being greedy on selling cash secured puts to make lots of return on our money and try to set ourselves up for the unusual events. And you'll find that by knowing that volatility is extremely low right there, that tells me I'm going to buy a call rather than sell a put. You know, do I want to buy or sell? It's going to control that. Okay, so there's a lot to think about. Any questions?
No.
Anybody else want to add anything to my little meeting?
I think good foundation in volatility. It's a lot to absorb. So, you know, hang in there, Jamie.
Yeah, definitely. I'm glad you recorded this. I'll go back over some of it. It was a lot to digest.
Well, and this was my introduction. I'm going to slow down from here on out, and we're going to focus on the Greeks, and we'll pick this apart and start applying it in trades. I didn't have time to. I had a terrible day yesterday. I was going to pick out a trade and do this whole thing with an example. But that's what I'm going to do from now on. I will come in with a trade example and use this kind of methodology, this thinking, to build that template that I posted in Word, to build my trade.
Okay, yeah, I think that'll be really helpful.
Okay.
All right.
Good talking to everybody.
Randy, thank you, and see everybody. We're going to do Thursday next week, right?
Thursday next week.
Perfect.
Yeah, good
Thanks.
luck.
Okay. Bye-bye, everybody.
Right,
Bye.
bye.
Thanks.
It ended. And it actually ran through, and it was a number that wasn't in your phone.